Did the Fed just send your portfolio into a tailspin? Don't panic because we've got your back. In this video, we'll show you how to turn this market crash into an opportunity to make some serious gains. The Federal Reserve's announcement a few days ago has made it official. The benchmark interest rates have been raised by another 25 basis points. This puts us at the highest interest rates seen since the early 2007 period, right before the Great Financial Crisis. What's more, home sales have just posted their first year-over-year decline in over a decade, leading JP Morgan to warn that we may have already passed the point of no return. The Federal Reserve has indicated they are far from finished with these changes. That's why it's crucial that we discuss what's going to happen throughout the rest of 2023, what new changes are taking place, and which of your investments are most likely to be impacted. Don't forget to click the first link in the description to get a chance to win a $750 gift card right now. Buckle up and get ready for a wild ride as we navigate the aftermath of the Fed's latest move. In a historic move, the Federal Reserve increased interest rates from 0 to 4.5% at its fastest rate hike ever. As a result, inflation has been steadily decreasing from its peak of 9.1% in June 2022. However, the latest inflation report on March 14th revealed that inflation is still up by 6% from a year ago, with prices rising 0.4% from the previous month. This suggests that if the current trajectory continues, we could potentially see sub-5 inflation by next year. Nevertheless, it's important to note that we cannot assume everything will continue at the same speed, given the unpredictability of factors such as the Fed's skyrocketing balance sheet and the volatility of Silicon Valley Bank. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. Currently, housing is the largest contributor to inflation, with the overall cost of shelter increasing by 0.8% month-over-month or 8.1% year-over-year. Housing comprises over a third of the overall inflation reading, with rent index and owner's equivalent rent both rising by 0.8% and 0.7% month-over-month, respectively. This suggests that inflation may persist longer than expected. However, the good news is that rents are often a lagging indicator, reflecting deals and leases signed months prior. With national rents beginning to drop, upcoming inflation reports may show a decrease in housing-related inflation. Apart from housing and food, which increased by 9.5% over the last year and 0.4% month-over-month, respectively, other factors contributing to inflation are yet to be analyzed thoroughly. While some items like energy, gasoline, and used cars declined, and medical care services decreased by 0.7%, these reductions are promising indicators that inflation is beginning to decrease. The most recent rate hike by the Federal Reserve, announced by Jerome Powell, has implications for the entire market, as many changes are expected in the coming months. In an intriguing article from the New York Times, the headline states that lower rates were meant to last, and without them, finances are in for a rough ride. The 2010s saw interest rates, inflation, and growth all hover around the 2% mark until something broke. Comment recession if you would like us to make more videos like this in the future. One of the first dominoes to fall was Silicon Valley Bank, whose bond values dropped due to the Fed's rapid rate increases. This occurred during a time when venture capital was drying up and company expenses were rising, causing their portfolio to take a massive hit. However, this phenomenon isn't unique to Silicon Valley Bank alone. The news reports that U.S. banks currently have unrealized losses of $620 billion from treasuries that have fallen in value due to the Federal Reserve's actions. The news goes on to explain that rising interest rates have been a recurring source of financial pain in the United States. The sharp rise in interest rates caused the savings and loan crisis in the 1980s, the bursting of the dot-com bubble in the early 2000s, and the decline in home prices during the 2008 Great Financial Crisis. These events illustrate the impact that the Federal Reserve's interest rate decisions can have on the economy and the financial sector. Despite recent banking turmoil, the Federal Reserve went ahead with its expected 25 basis points increase in interest rates. This move suggests that we may see a peak federal funds rate of 5.1% by the end of 2023, with 2 more rate hikes expected in May and June. If inflation begins to come down, it's anticipated that rates will hold steady for the market to adjust. However, if inflation continues to rise, rates will probably increase even higher. While the GDP numbers were revised downward, there is no indication of a recession as long as the unemployment rate remains below 4%. Additionally, Jerome Powell noted that the banking crisis had a similar effect to an additional rate hike, allowing for a step back from further rate hikes as the economy slows down. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. The Fed's rate hike and projected future increases have impacted the housing market, causing a decline in demand and prices. Home sales have slowed, with fewer new listings as homeowners lock in their rates. Goldman Sachs reports that 99% of homeowners have an interest rate below what is currently being offered on the market, and 63% of those loans are between 2.5% to 4%. This means that current homeowners have little incentive to sell their homes and get rid of an interest rate that would be significantly higher if they moved, especially if they are one of the 28% that have a rate below 3%. Additionally, if a homeowner currently has a 3% mortgage, prices would have to drop by 35% for that identical home to have the same monthly payment as today's current rates of 6.5%. Thus, in many cases, it doesn't make financial sense to sell unless they absolutely have to. The housing market is facing a drop in value, with Goldman Sachs predicting a 6.1% decline in housing values for 2023. However, a lack of new supply is keeping home prices relatively high despite slowing demand. Lower mortgage rates have sparked interest from buyers, potentially leading to a 3.1% increase in home prices year over year. Inflation appears to be subsiding, which could be positive for stocks that benefit from lower rates. The S&P 500 price-to-earnings ratios have returned to 2018 levels. Although the stock market's future is difficult to predict, there is optimism that it will rebound as it is forward-thinking. The end-of-year market estimates range from 3,600 to 5,000, making it challenging to predict. The Federal Reserve is committed to fighting inflation and reaching its 2% target. Don't forget to click the first link in the description to get a chance to win a $750 gift card right now.